Okay, so picture this. A hurricane finally passes, or the floodwaters start to go down. Your first thought is, okay, let's rebuild. But then comes the second storm, the paperwork, the claims, the waiting. What if there was a better, faster way to get help? Well, that's what we're talking about today, a new idea called parametric insurance.
So, to really get why this new idea is such a potential game changer, we first have to talk about the old way of doing things and why it's so often broken.
I mean, if you've ever known anyone who's been through a major disaster, you've heard the stories. The event itself is devastating, but the wait for financial relief, that can be its own kind of torture. It just drags on and on. So why? Why is the system so incredibly slow, right when people need help the most?
Well, here's a side-by-side that says it all. On the left, you've got traditional insurance. It's a maze, right? You file a claim, then someone has to come out and assess the damage. Then there are disagreements, negotiations, and eventually, maybe you get a payout. But look at the right. That's the ideal. An event happens, a preset trigger is met, and boom, the payout is automatic. It's a straight line, not a maze.
So how do we get from that complicated maze to this simple, straight line? Well, it takes a totally different way of thinking about what insurance even is.
And this is it, the core idea. Instead of asking, okay, how much damage did your property suffer? Parametric insurance asks a much simpler question. Did a specific thing happen? The payout isn't tied to an adjuster walking around with a clipboard. It's automatically triggered the moment an objective, pre-agreed data point is hit. Like, say, winds reaching 150 kilometers per hour, or rainfall topping 300 millimeters.
And honestly, this is a huge shift in thinking. We're moving away from a system that relies on slow, often subjective damage reports to one that's powered by fast, objective, undeniable data. It's all about trusting the numbers to get money where it's needed fast.
Okay, so it sounds great in theory, right? But how do you actually build one of these policies? What are the nuts and bolts that make it all tick?
You know, the process is actually pretty logical. First, you pinpoint the areas that are most at risk. Then, you pick your parameter. Are we worried about wind, rain, earthquakes? Step 3 is the real key. You define the exact trigger, the line in the sand. For example, rainfall has to go over 300 millimeters. Then you decide the payout. And finally, and this is so important for making it all trustworthy, the entire system has to run on reliable, independent data from sources everyone agrees on, like a National Weather Service or a geological survey. No arguments.
So that's the how. Now for the fun part, let's look at the where. Because this isn't just an idea on a whiteboard. It's already being used out in the real world.
Take a look at this real-world example from Nagaland in India. What I love about this is that it's not just an on or off switch. It's a tiered system. If the rainfall hits a certain level, boom, a 15% payout is triggered right away for immediate relief. If things get even worse and it hits a higher level, the rest of the payout is released. It's a smart, scaled response that's completely driven by the data.
And what's so cool is how flexible this model is. It's not just for floods. For an earthquake, your trigger could be a certain intensity level on the Mercalli scale, basically a measure of how much the ground shook. For a cyclone, it's all about wind speed. For rain, it's the total amount. You can custom build a data-driven trigger for almost any kind of disaster.
And check out how precise it can get. This is for rainfall coverage in Assam. They've literally divided the whole region into a grid. Using satellite data, they can see exactly which little squares on this map got more than their threshold of rain. That means the payouts can be incredibly targeted, going only to the areas that were verifiably hit the hardest. It's pretty amazing.
Now there's a big question hanging over all of this. Who on earth has enough money to pay out for these massive disasters so quickly? That's a huge amount of risk. Well, this is where the financial plumbing behind the scenes gets really interesting. The whole system works because of something called reinsurance. And really, it's just what it sounds like. It's insurance for insurance companies. When your local insurer is looking at a massive potential payout, like from a huge hurricane, they don't bear all that risk themselves. They pass a chunk of it on to an even bigger company, a reinsurer. So think of it like a chain. You buy your policy, your insurer then turns around and buys its own policy from a reinsurer to cover its back. What this does is take the catastrophic financial risk of one single event and spread it out across a huge global market. It makes the whole system way more stable and able to handle these massive shocks.
Okay, so let's zoom back out and tie this all together. We've seen how it works, we've seen who pays for it, so what's the ultimate impact of all this?
Well, the advantages are pretty clear. The #1 goal is faster payouts, and it nails that. Because it's based on objective data, you basically eliminate all the back-and-forth arguments. But maybe the most crucial benefit is that it injects liquidity, cold hard cash, into a disaster-stricken community immediately, right when they need it to start buying supplies and paying for repairs.
And that's the bottom line. This isn't just some clever financial trick. It's a tool for building real, tangible resilience. When you cut through all the red tape, you give communities the power to stop waiting and start rebuilding way faster than they could before.
So that leaves us with a pretty big question. As we see more and more extreme weather events, our old, slow systems just aren't cutting it anymore. So you have to wonder, is this kind of fast, data-driven, automatic system the future of financial first aid? It just might be.